Hello everyone, and welcome to Financial Education. Today we're going to break down one of the most important concepts in investing, earnings per share, commonly known as EPS. What exactly is EPS? How do you calculate it? Why do investors care about it? And how does it change over time? We'll cover all of that and more in this video. Let's begin with the basics. Earnings per share is a financial metric used to evaluate how profitable a company is on a per-share basis. Instead of just looking at total profits, EPS helps investors understand how much profit is attributed to each individual share of stock. This makes it easier to compare companies of different sizes while accounting for how many shares they have outstanding. In general, companies with a higher earnings per share tend to be more profitable than those with a lower EPS. However, it's important to remember that EPS does not measure total profitability. It strictly shows profitability relative to the number of shares in circulation. Now let's talk about how earnings per share is calculated. The formula is fairly simple. You take the company's net income, subtract any dividends paid to preferred shareholders, and then divide that number by the total shares outstanding. You may also see net income referred to as profit or earnings. In most cases, these terms are used interchangeably. What we are really looking for is how much money the company earned after covering all of its expenses. If you want to find the information needed to calculate EPS, you can look at a company's most recent quarterly or annual financial statements, which are usually available on the company's website. Another easy option is to use a financial data platform like Yahoo Finance. Simply search for the company, navigate to the summary section, and you'll see earnings per share listed there. So why does EPS matter to investors? One of its biggest advantages is that it allows you to compare the profitability of different companies, even if those companies have very different total profits or share counts. An example will make this clearer. Let's say you're trying to decide between investing in two businesses, Oliver's Bike Co. and Nathan's Home Flooring. Oliver's Bike Co. earns $4 million in profit each year and has 300,000 shares outstanding. To calculate EPS, we divide $4 million by 300,000 shares. That gives us an earnings per share of about $13.33. This means that for each share of Oliver's Bike Co., the business generates roughly $13.33 in profit. Now let's look at Nathan's Home Flooring. This company earns $50 million annually, pays out $2 million in dividends, and has 6 million shares outstanding. To find EPS, we start with $50 million, subtract the $2 million in dividends, and then divide the remaining amount by 6 million shares. That results in earnings per share of $8. Now that we've calculated EPS for both companies, we can compare them directly. Even though Nathan's Home Flooring is much larger and generates significantly higher total profits, Oliver's Bike Co. actually produces more profit per share. What this tells us is that once we account for the number of shares, Oliver's Bike Co. is more profitable on a per-share basis. In practical terms, a $1,000 investment in Oliver's Bike Co. would give you a claim on more earnings than investing the same amount in Nathan's Home Flooring. Earnings per share is not a static number. It can change over time, and those changes are driven by two main factors: the company's profit and the number of shares outstanding. First, let's consider profits. If the number of shares stays the same from one quarter to the next, and the company earns more money, EPS will increase. If profits decline while the share count remains unchanged, EPS will decrease. This relationship is straightforward. Higher profits lead to higher EPS, and lower profits lead to lower EPS. The second factor is the number of shares outstanding. Suppose a company's profits remain relatively stable, but it issues additional shares. In that case, earnings per share will fall because the same amount of profit is now spread across more shares. On the flip side, if a company reduces its share count while maintaining the same profit level, earnings per share will rise. This happens because there are fewer shares dividing up the same earnings. This is one reason companies sometimes repurchase their own stock, a process known as a stock buyback. When a company buys back shares, it reduces the total number of shares outstanding, which can boost earnings per share. It's important to remember that earnings per share is just one tool among many. While EPS is useful, it should always be considered alongside other financial metrics when analyzing stocks and making investment decisions. Alright, that wraps up today's breakdown. I'm curious how you use the EPS when evaluating stocks. Do you rely on it heavily, or is it just one piece of your analysis? Let me know your approach in the comments. Before you go, I want to share something with you. I've created my own ETF portfolio, and if you'd like to see how it's performing, I've linked it down below. If this video helped clarify things, consider liking the video and subscribing to FinEd for more straightforward financial education content. Thanks for watching, and I'll see you in the next one.